and a very warm welcome to this week's Policy Watch, our weekly program that keeps you abreast of all the major economic developments during the week. Our three top stories this week are the Big Bang reform announced in FDI, foreign direct investment, the rescue efforts mounted by the Reserve Bank of India in the forex market, and the government's decision to issue an ordinance to empower capital markets regulator SEBI. And joining me in these discussions is a very special guest, Dr. Subir Gokarn, Head of Research at Brookings India and former Deputy Governor of the Reserve Bank of India. Welcome to the program, Subir.
Thank you, Mathili. Thank you.
Well, our first two stories are more or less linked, but acting on the recommendation of a committee headed by Arvind Mayaram, Secretary, Department of Economic Affairs, the government has hiked the ceiling on foreign direct investment, FDI, in a host of sectors, including telecom, single brand retail, and oil and gas. Better still, the need for prior approval of the FIPB, which is a Foreign Investment Promotion Board, has been done away with in a number of sectors, provided the FDI is within a specified ceiling. The move comes in response to the problems posed by a growing current account deficit that is putting pressure on the rupee and raising the spectre of a serious crisis on the external front. It also comes less than a year after the government allowed FDI in multi-brand retail trade and raised the cap in FDI in civil aviation to 49%. What does this mean for the country? How much more money can we hope to get? We'll discuss all this and more with Subir. But before we do that, let's hear this Bureau report.
Commerce Minister Anand Sharma announced the government's decision to further liberalize the rules for bringing foreign investment in at least a dozen sectors. Most anticipated among these was the decision to allow 100% FDI with a caveat that investments beyond 49% would require the approval of the Foreign Investment Promotion Board under the Finance Ministry.
There is a raise of cap from 74 to 100% in basic and cellular services. Up to 49% it remains under automatic route, 49 to 100% through the FIPB approval route.
100% FDI in courier services is now allowed through automatic route. The government removed the need to obtain FIPB approval for petroleum and gas refining, commodity exchanges, power exchanges, stock exchanges and depositories while retaining the 49% limit. 100% FDI is allowed in asset reconstruction companies, but foreign investment above 49% would require an FIPB nod. Credit information companies can have up to 74% FDI through automatic route. In a major relaxation to the retail sector, the government has done away with the requirement of FIPB approval for investing up to 49% in single brand retail chains. In order to leverage India's huge defence imports to earn foreign money, the government inserted a special provision to allow up to 100% FDI in defence production for acquiring modern technology.
The only difference being that here the CCS will take the call. Only those proposals will be sent to the CCS for FDI in defence above 26%, where state-of-the-art technology is involved in defence manufacturing.
India is the world's largest arms importer and its armed forces buy military equipment worth billions of dollars every year. The country is also about to finalize some big-ticket defense purchases, including a $20 billion deal to acquire 126 fighter jets from France. Though India has an elaborate offset policy, but a sectoral cap of 26% is considered an impediment in bringing in foreign capital in the sector.
Subir, after almost 4 years of inaction on the policy front, the government suddenly seems to have gotten to overdrive. September last year, we saw the FDI in retail, and now suddenly there's been a host of FDI hikes. What really explains the need? Why is there a sudden desperation, quote-unquote, to get more foreign direct investment?
Well, I think we have to look at it from two perspectives. One is the merits of opening up these previously limited or restricted sectors to FDI. Let's not put it in the specific context of what's happening today. Okay. And the second is then why today, as you're saying, why not a year ago, 2 years ago, 3 years ago?
It could have had some impact.
When it could have had, perhaps even more. If you think it's going to be positive today, it should have been positive 3 years ago as well. I think from the first perspective, which is the merits of FDI, increasing FDI flows into certain sectors, there are two very clear motivations. I think both of them have come through in the statement that the minister just made. One is that these are sectors that are facing resource constraints in their efforts to expand. So if they're being done by Indian companies with FDI limits, resources are becoming a little scarce, and so the possibility of expansion is starting to fade out. And I think telecom is one example where essentially coverage is now plentiful, but technology is growing, quality is obviously suffering, so some investment needs to be made in terms of keeping the network, making the network more efficient. All these factors require more resources. There is more technology out there which perhaps can come into play here. On the defense side, as was also said, that at this point, trying to reinvent the wheel on every product is proving to be extremely not only is it proving to be inefficient from a cost perspective, but it's also risking security because you just don't know when the delivery will take place, if at all. So bringing foreign technology in, again, tried and tested, perhaps at least tested somewhere, you're jumping up the sort of the life cycle of the product, and to the extent that it's bringing technology into the country, it has that positive. So these are merits independent of the current macro situation.
Okay.
These are arguments in favor of opening up on these sectors
at any
regardless,
point
at any point. And that, I think, points then to, or raises the question as to why these decisions are not taken in other circumstances. Well, that's where I think the pressure of circumstance, the force of circumstance, as it's called, famous short story, becomes important. These are measures that were obviously resisted by various stakeholders at various points, and there wasn't any external compulsion for the government to act. Now you have that. Now you have a situation where a balance of payments stress, I wouldn't use the word crisis, but I certainly use the word stress, is very vivid. Everybody sees it. There is no need to, or no room to question or quibble about whether we are in a very severe stress situation. So that then starts to weaken the resistance, because the government has the argument, hey, look, if we don't do it now, there are consequences awaiting. We don't know how things are going to play out. So that, I think, creates an opportunity. So the opportunity is created by the current stress on the rupee, on the overall balance of payments, and that opportunity is used. That opportunity was not so vivid, not so visible 3 or 4 years ago. I think that then raises the second question. Because of the circumstances, are these measures going to have an impact?
And that is the irony, because actually the external sector problems require a quick solution, whereas FDI, you cannot really expect to see quick inflows.
I think you're absolutely right. I think it's like in any household situation or corporate situation, and you can't use channels which take time, which involve strategic thinking and strategic decision making to solve your liquidity problem. FDI decisions are strategic. You're not going to get the money in overnight, because people are now going to evaluate the opportunity, look at the prospects, say, hey, look, is this a good business environment to put our money in? And to a large extent, we keep making this distinction between foreign investors and domestic investors as though they're from separate planets. They're not.
It's not true.
They fundamentally react to the same incentives.
And we've seen from the doing business.
If we are not able to persuade domestic investors to invest, and that's what everybody's complaining about, I don't see how we're going to persuade foreign investors to invest. So I think the challenge here and the larger compulsion is, how do we get the investment climate back on track? How do we make it more attractive for everybody to invest? In that scenario, FDI being more open, restrictions being lifted, makes a lot of difference in terms of people's ability to come in. And I think that's the perspective which has to be kept in mind, which is, if you use FDI as an instrument, you're taking a strategic perspective, not a tactical, not an operational perspective.
Because ironically, on the very day that the government announced this, we saw 2 foreign investors actually announcing their decision to pull out. So I think on that note, we just will have to take a break, but please do stay with us. We'll be back very, very soon. Welcome back. In a bid to restore stability to the foreign exchange market, the Reserve Bank in India announced a number of measures just the day before the government announced its Big Bang reform in FDI. The measures, which were aimed at tightening liquidity in order to quell speculation against the rupee, however, had mixed results. While the rupee recovered marginally the next day, the stock markets fell even lower as bond yields rose sharply. The RBI moves are often very difficult to comprehend for the lay public, who are more concerned about what the rising rupee means for their monthly budgets. Luckily for us, we have Subir to demystify what the RBI's actions mean. But before we do that, let's hear this bureau report.
The Reserve Bank of India's attempt to remove 12,500 crores from the system through a bond issue failed, with the central bank managing to collect only 2,500 crore. The bond issue was part of several measures initiated by the